Hello, and thanks for joining another edition of Max Financial Services Stock Market and Economic Update Market Call. Today is January 29th. The month is almost over. It is a Friday. I know we usually do these on a Thursday, but we had a scheduling conflict, so thanks for joining us today. And if you're watching this as a replay, well, we still thank you for that. If you want to participate, you can consider joining our live blabs that we do, and the schedule is posted directly on the website. So we'll get started as usual. And what's interesting is I had these numbers prepared for yesterday. However, I updated everything just because of the way that the markets behave today. So today was a really good day for the markets for the most part. Everything was basically started from the fact that we had overnight news out of Japan, which we'll talk over shortly. But the Dow Jones finished up the day at 16,466, a gain of about 400 points just for today, and a gain of about 600 points for the last week. So for the last week, we're up close to 3%. The S&P 500 joined in similar gains. We finished the day at 1,940. Last week, we were at 1,877. Altogether, we had once again about a 3% gain. Now, keep in mind, these are significant numbers. However, we're still well off the tops. Oil finished the day at $33.56 a barrel. We were higher up in the early morning hours. However, towards the close, we finished down at $33.56, which is still a good sizable gain from last week where we finished at $29.80 a barrel. Now, if you missed it, if you weren't looking at numbers, actually oil was as low as in the 26s. We had some news that came out, and that shot the prices of oil up, and it's stabilizing here. Gold was pretty constant. Gold finished at $1,117 an ounce. Last week we were at $1,108 an ounce, so a gain of $9 an ounce for the week. Silver was fairly flat. We finished at $14.26 an ounce of silver, and last week we were at $14.24 an ounce. The VIX, which is once again the volatility index. Typically, what you're looking at, if there's volatility in the markets or if the markets are going down, typically the VIX is going to be shooting up. The VIX is at 2414. Last week we were 2415, so slightly lower. But once again, though, just yesterday the VIX was at $25.14. That is still well above where the VIX should be in sane markets. So typically the VIX was right around 13, 14. So we are elevated. Perhaps the biggest move is in the bond markets, and typically not the way that you would really expect bonds to go. So even though we had a major rally in the stock markets, the bond markets also rallied, but they actually rallied to the upside with the yields coming down. So the 10-year Treasury bond, the U.S. Treasury bond, finished the week at a yield of 1.93%, which is down from a yield of 2% just last week. And the 30-year yield dropped down to 2.75%, down from 2.78% last week. Once again, this is all completely counter what the Federal Reserve was trying to do, which is to raise interest rates. So why did it basically happen? So we had a couple of big economic reports come out, but the biggest report that came out last night was the fact that the Bank of Japan has actually lowered interest rates, that the Bank of Japan now has negative interest rates. They lowered the national rate down to a negative 0.10%. Basically, negative interest rates, you're paying your bank money to hold your money for you. All of this has been happening in several European nations, particularly in Switzerland. They've had negative interest rates for a while. But really two ways that happens. Number one is if either people are afraid and they're willing to pay to secure their money. And number two, basically, you have a deflationary environment, which we have been seeing deflationary pressures. The third reason why that may happen has been happening in the case of Japan in order to encourage companies and people to go out and actually spend money, they would lower interest rates. So when you have to pay interest on your money, they'd rather see companies go out there and invest. They'd rather see them invest in machinery. They'd rather have people go out and buy a new iPhone if you want, because basically that would help spur the economy and so forth. The deflationary problem is a global problem, and particularly when Canada and several European nations are in a recession already. They've taken large tumbles. Deflationary pressures are basically going to continue, and it's kind of slowly translating to the United States. So over the last week, we had a couple of economic reports, plus one that just came out today, which we'll add to the list. So a couple of days ago, the durable goods orders came out. The durable goods orders fell 5.1% in December versus a gain of 0.2%. So that was a major surprise to the downside. No one really expected that to happen. People were still expecting a little bit of a gain. Typically, durable goods orders, they would include machinery, they would include industrial purposes, they would also include airplanes. So airplane orders were down a little bit, and it had an effect on the numbers, but just overall, it seems like the big industrial purchases, they are slowing down. The one piece of good news, though, was new home sales were up 10.8%, up to an annualized rate of 544,000. However, and our real estate professionals would probably appreciate that the median price of a new home actually fell 2.7% to $288,900. And that's a one-year rate drop of 4.3%. So the reason why we actually had more homes sold, but they were sold at a lower price. And typically we had a little bit more supply coming onto the market. Overall, it's still constrained, but it seems like home builders are willing to discount the homes a little bit more. So that's one of the things that's basically happened. So kind of good news, but bad news scenario as well. The Federal Reserve, they had a meeting and they decided to keep rates steady. So there was no hikes. I know some people basically expected 4 Federal Reserve hikes in the interest rates this year. Wasn't happening. So we'll see basically in March if that's going to happen again or not. But the notes that were released for the meeting, they were a little bit different. And it seems like basically the Federal Reserve is watching what's happening in the markets overseas, because ultimately what we really don't want to see happen is that the United States is the only economy that would be raising rates. Meanwhile, everybody else is lowering rates. Would not really be good for the U.S. consumer, because basically we'd be stuck with holding the bag. And finally, this morning we had the GDP numbers and for the fourth quarter, and the U.S. economy grew 0.7% in the fourth quarter, well below expectations, especially considering it is the fourth quarter and more people are spending a lot more money for the holidays and so forth. So we'll see what basically are people going to be looking to blame for that. All of this really should paint a picture that, hey, you know what, things are not as peachy keen as politicians would like you to believe. Once again, though, from no president wants to be blamed for entering the country into recession, even though a recession is perfectly healthy, it's perfectly normal. But nobody wants to basically be the person who led the country into the recession on their watch. But things are not 100% all right. And as things basically get worse, more than likely we will get dragged on into a recession probably towards the end of this year. And the fact that more economists, more Wall Street people are talking about the fact that the recession is likely, well, if you think about it, it'll probably happen. Once again, though, it's something we've been talking about for a while, and in the beginning of the year, end of last year, beginning of this year, we actually published our predictions for 2016. So I will include a link in the commentary, and you can watch it on YouTube. And once again, though, you can catch all the articles on seekingalpha.com. Just search for Maks Financial Services. Okay, so let's get on with it. Notable earnings releases. So once again, we're getting more of a gloomy picture in certain regards, and definitely for the strategy of, hey, just buy an index fund and that's it. when markets just basically go up, it's okay just to buy anything and focus on lowering the fees, because hey, if the markets are going up as a whole, everything's going to go up, so it almost doesn't matter what you're going to invest in. When things are flat or slightly down as they were last year, or significantly down as they are this year, this is where active portfolio management makes significant sense. You want a portfolio manager who actually is going to go buy the good companies, and you want to make sure that basically the baby's not going to get thrown out with the bathwater as well. So on the earnings front, Facebook released earnings and is up sharply on great Instagram numbers. So Facebook has been able to monetize their platform. They've been able to generate more money. They've had good acquisitions. Overall, I mean, they're hitting it out of the ballpark. No matter whether you like Facebook or you don't like Facebook, they have been doing a good job as a business. And the shares and the shareholders have actually been largely rewarded. On the flip side, Amazon, Apple, Samsung, Electronic Arts, and there have been a couple of others, they're down sharply, and they're down sharply on disappointing results. Amazon basically reported record earnings, but the fact of the matter is they weren't growing as fast as they could have been. And Amazon, I mean, the fact that people are willing to pay ridiculous multiples for Amazon, for a company that relatively, based on how much business they generate, is almost unprofitable. But people are willing to pay those prices for such a long time. And now it's basically coming back to hurt them. So Amazon was down, I believe, right around 12 or 13% just yesterday after hours. Don't know how it closed out today. Apple, basically same story. Apple had all-time record earnings, but once again, people are willing to pay way too much money for Apple. And now there's there are a couple of bad reports that are coming out from the supplier side for the iPhones. The iPhone numbers did not hit it out of the ballpark. They slightly missed expectations. However, one of the things that really bugged investors was Apple's outlook for this year. They actually they didn't basically say it, but Apple is expecting a drop in units sold across the board. Along the same line, iPad numbers were kind of disappointing from the perspective of the average sales price. Even though Apple released the iPad Pro, the average selling price for all iPads was actually down. So either they're not selling that much of the iPad Pros, or they're basically discounting the other products, or people are going to the cheaper minis and so forth. Ultimately, it comes down to, with Apple, it's they're great products, but let's put it this way: if you have an iPad Air, it's probably going to do the same thing as an iPad Air 2. And it's probably going to run the same apps as an older iPad second generation or the new iPad was going to be able to do. So people aren't replacing iPads as quickly as they're expecting. And on the iPhone side, I mean, like, they are slowing down a little bit more. Have we hit saturation point with iPhones? Possibly. But all that basically goes to show you is that a company can do great, and then all of a sudden, after a while, I mean, that growth may not be forever. And that's why typically a lot of the companies, they're trying to go into the service model where things are going to be more recurring rather than depending on a one-time sale, and that's it. Samsung was down sharply once again, though. I believe the revenue numbers were not as high as expected, and same thing for Electronic Arts. So we had a mixed bag. The good news is, if your investments, if you're an active manager, if you're doing your due diligence and you're doing your research on the investments, this is a great time for you, because now you basically don't really have many excuses. An active manager, this is basically the time where we're going to show that they're worth the fees that they charge. We're going to show that, hey, you know what, we're actually doing what we're planning on doing. On the flip side, if you have an index fund, well, if the markets are down 8-9% for the year, this is pretty much what you're going to expect. So that's on the earnings front. More numbers are going to be coming out soon, so we'll keep on them as we usually do. On the global macroeconomic front, so once again, oil rose sharply for the week on the reports that Russia and OPEC would meet, or at least are open to talking about a production cut. An oil production cut. Once again, though, reports were denied by both OPEC and Russia. However, they basically did say that they are open to having those discussions. However, there's nothing set in stone on that yet. Oil is a twofold issue. Number one, we have too much oil coming out of the ground. And number two, demand is significantly lower. Demand is lower because cars are getting more efficient. Demand is lower because a good 1/3 of the world is in a recession, and China is now basically joining them, and there's a slowdown in China, so there's significantly less demand for oil. It's going to be interesting to keep a watch on. However, it's not likely that we're going to see significant cuts in production. And if we're going to have lower demand, it's going to keep putting pressures on oil to be lower. One of the reports I recently read, there was a director from one of the non-government organizations who keep track of energy production. They were expecting that oil was going to stay this low until at least 2020. So we've got another 4 years or so. And keep in mind, though, if we have deflationary pressures, it's going to keep putting the pressures down on all the prices, not just oil. Lastly, one of the things we were following and talking about last week, the sanctions on Iran have been lifted. And the first thing that Iran has done is actually confirmed their deal with Airbus for 118 jets. So a lot of the money that they basically were getting as part of the nuclear deal is now going and basically being spent on buying airplanes. The other thing that basically happened was they signed deals with Greece in order to supply them with oil. And they signed deals with Russia in order to come in and actually start developing a lot of the oil fields that they have. All in all, it's going to add more production to the oil markets. It's not going to be significant. I believe it was like less than 0.5%. However, it's still going to have an impact, and it still adds more oil production to the markets. And that's on top of the oil that's basically being delivered on the black markets by ISIS and Turkey and so forth. So hopefully that gives you pretty much a good roundup of what we had this week. Key takeaways: gloomy, mixed picture. You got to know what you're invested in, and you got to have a strategy. One of the things I ask most of the people we work with and people that we meet is, what's your downside risk management strategy? If you don't know it, it's time to chat. So hopefully this was helpful. We'll leave it for, we'll open it up for questions in case anybody has any. And otherwise, we will see you next week. Take care.